All right. The closing bell has just rung on Monday, January 26th. The screens are frozen.
The numbers are final.
Exactly. And, if you just glanced at the headlines on your phone, you might think today was, well, a total non-event.
Right.
But we have a stack of data here from volume profiles to gamma exposure maps that suggest the calm surface is hiding some incredibly dangerous currents.
Oh, yeah.
So we're doing a deep dive into the post-market analytics to figure out if this is a pause before a breakout or maybe the silence before a storm.
It's definitely one of those days where the price is lying to you.
But the volume is telling the truth.
That's it. The volume's telling the truth.
Let's start with the scoreboard then, just the hard data. No pleasantries. The S&P 500 finished, essentially flat, scraping together a marginal gain of just 0.08%.
Barely.
The Nasdaq was the laggard of the session, slipping into the red by about 0.14%.
Yep, saw that.
And the Dow Jones, that led the pack, putting up a gain of 0.31%. But the sector split? That's where it gets interesting.
Always is.
Energy led the board tightening supply forecasts, driving that, while technology lagged. Pretty significantly. We saw a clear rotation out of those high multiple AI names.
And right off the bat, that rotation is the entire story. It's the classic post-close picture where the headline numbers look, calm, but the internals are screaming.
Right.
If you just looked at the Dow, you'd think, okay, solid risk on day, blue chips are buying. But when you see the Nasdaq slipping and that specific move out of tech, which that has been the engine of this whole bull run.
The whole thing.
It tells a very different story about risk appetite.
It feels paralyzed.
Yeah.
We're seeing volume, which we'll get to, but the price action on the indices is just going nowhere. So what is the actual narrative here?
It's a choppy mess. That's the technical term for it. It's a deception at the top.
A deception.
Yeah, we're in a classic wait-and-see equilibrium. Think about the context. We had that massive rally in early January, so buyers are exhausted from that effort. They've spent their ammunition.
But sellers don't have a reason to hit the bids.
Exactly. On the flip side, sellers lack a genuine catalyst to really break the floor, so the market is just holding its breath.
Holding its breath for what? Exactly. We keep hearing about this wall of worry.
Right.
Usually that's a metaphor, but looking at the calendar this week, it feels pretty literal.
No, it's literal.
What are the bricks in that wall right now?
You almost cannot overstate how much event risk is packed into the next 72 hours. It's a macro collision course.
Okay.
First, you have the Magnificent Seven earnings. We've got Microsoft, Tesla, Meta, and Apple all reporting this week. That is a huge percentage of the S&P's total market cap right there.
And that's not just about their stock prices. It's about the whole narrative, right? If they stumble, the AI growth story takes a massive hit.
The whole thing gets questioned.
Okay.
Exactly. And right behind that, you've got the fiscal dysfunction. The U.S. government shutdown deadline is looming on January 31st.
And the grand finale.
The FOMC decision on Wednesday.
So we have corporate earnings, fiscal chaos, and monetary policy all converging.
In a 72-hour window, it's a steamroller. And right now, the verdict is just neutral because nobody wants to make a massive bet in front of it. Sentiment is flat.
But flat doesn't mean safe.
No, flat just means the betting windows are closed.
Let's look under the hood, though. You said the price lies, but volume tells the truth. Today wasn't a low-volume snoozer. Volume was actually above average.
Yep, above the 30-day moving average.
And it continued that momentum from Friday's 17.3 billion share session.
And that is the contradiction that should keep you up at night.
Why? Usually, volume validates price. If the price is flat, shouldn't volume be low?
Usually. But if volume is high, meaning there's a ton of trading activity, a lot of shares changing hands, and the price doesn't move, what does that tell you?
A battle.
A massive battle. It's a churn. For every buyer stepping up, there is a seller hitting the bid with equal force. It's a transfer of ownership, probably from the impatient to the patient, or, arguably from the bulls to the bears.
So let's talk about who is winning that battle. We track market breadth for this. Today seemed incredibly narrow.
Narrow is putting it politely. The breadth divergence was ugly. The S&P 500 was flat, sure, but the NYSE advanced decline ratio was a dismal 0.7 to 1.
So for every stock that went up, more than one went down.
Yep, so the index didn't drop, but the average stock did.
Okay.
It was a hide in big tech day, even with the Nasdaq lagging a bit. The real pain was in the small and mid caps. The Russell 2000 was down 1.2%.
That's a big move for one day.
It's a huge move. Investors are pulling money out of the sensitive economic growth parts of the market, the companies that actually need a good economy. And they are parking it in the Fab 5 mega caps.
Treating Apple and Microsoft like a savings account.
It's an insurance policy disguised as an ETF. When you see the Russell tank while the S&P stays flat, it means the market is scared of the economy, but not yet ready to sell the generals.
That brings up a metric you've been watching. The percentage of stocks above their trend lines.
This is the stat that worries me most. Only 30% of individual stocks are trading above their 50-day moving average.
Wait, hold on. Let me contextualize that for a second. We're near all-time highs on the major indices.
Right. The roof is at an all-time high, but the foundation is crumbling. If 70% of stocks are in a downtrend, but the index is high, that's a house of cards rally.
It's fragile.
Mathematically fragile. If those top 5 or 6 companies stumble, say, during earnings this week, there is no support beneath them. The troops have already retreated.
We also saw a bearish divergence on the cumulative data. For the listener who doesn't track this daily, explain the cumulative AD line.
Think of it as a running tally of the Army's morale. If the market price makes a new high intraday, you want to see the cumulative advanced decline line also make a new high. It means the troops are marching with the generals.
And today?
Today, price made higher highs intraday, but the cumulative AD line, it failed to follow. It just didn't make a new high.
And in technical analysis, that's a major warning sign.
It's a flashing red light. It often precedes what we call a bull trap. It tells you the breakout is fake, the momentum isn't real, it's just algos pushing index weights around while they sell everything else.
I want to pivot to volatility because this is where the smart money usually shows its hand. We look at the VIX, the fear gauge. On a flat day like today, shouldn't the VIX drop?
It absolutely should. We call it theta burn.
Right, time decay.
Every day that passes without a crash is one less day of risk, so options usually get cheaper. But today, the VIX refused to break below 14.5.
So options aren't getting cheaper.
No, they're staying bid. We call this the smirk. The implied volatility curve is staying elevated. Traders are not selling their protection.
They're looking at that Wednesday wall.
They're looking at that Wednesday wall, the Fed and earnings, and they are saying, I don't care if today was quiet. I'm paying up to stay hedged against a gap down later this week.
This leads us into gamma. We talk about it a lot. It's about how market makers have to hedge their own books. Their hedging can act like a magnet or a force field. Where are those lines in the sand right now?
The landscape is defined by 2 huge levels. The ceiling is at 7,000 on the S&P. There is massive call open interest sitting right there.
7,000 is a huge psychological number anyway.
It is. And because there are so many call options open there, dealers are effectively long gamma as we approach it in plain English. As the price goes up towards 7,000, dealers are forced to sell stock to re-hedge.
So they act as a damper. They suppress volatility.
Exactly. It's like walking through mud.
Yeah.
The closer you get to 7,000, the harder it is to push through because the dealers are constantly selling into the rally. So, don't expect us to just slice through 7,000 without a major catalyst. It acts like a lid.
Okay, what about the downside? That seems to be where the danger lies.
That's the scary part. The put wall is at 6,800. This is must-hold support.
Yeah.
Above 6,800, dealers are stabilizing things. But if we break 6,800,
And flip.
we flip into negative gamma.
And negative gamma. That's the slippery slope scenario.
Yeah, the slippery slope. In a negative gamma environment, dealers are forced to sell into a decline. So if the market drops, they have to sell more to hedge, which drives the market down further, which forces them to sell more.
A feedback loop. A crash.
Exactly. If 6,800 breaks, we likely flush straight down to the liquidity pocket at 6,740.
Okay, so we are pinned between the mud at 7,000 and the trapdoor at 6,800. That explains the paralysis. But let's look at some individual names. The trade desk, ticker TTD, it plunged 7.5% today on a heavy volume. Sharpest decliner in the S&P.
This is a brutal lesson in execution risk in a high-rate environment. They announce a CFO change, and then there are reports of mounting competition. Now, back in 2021, zero interest rate world, the market might forgive a management shakeup.
He's just moving on.
Yeah, it's fine. But not today. Absolutely not. The market is ruthless. It is punishing uncertainty instantly. If you show weakness in the C-suite, the algos hit the sell button before the press release is even finished downloading.
They're not waiting around.
Why would they? They're saying, I can get 5% risk-free in a bond. I don't need to sit here and wonder if your new CFO knows what he's doing.
On the complete opposite end of the spectrum, we had USA Rare Earth, ticker USR. This thing surged 35%.
An explosion. And this is fascinating because it's a pure national security play. The news was a $1.6 billion U.S. government stake.
That's not just an investment. That's a stamp of approval.
It's policy. We're seeing capital rotate out of traditional tech and into strategic minerals. I mean, think about the global context, trade wars, tariffs, supply chain issues. The government needs to secure the supply chain for these minerals for defense and tech.
So USR isn't just a mining stock anymore. It's a hedge against deglobalization.
Exactly. It's a geopolitical trade. If you think the world is getting more fractured, more dangerous, you buy the guys digging the strategic stuff out of the ground in friendly jurisdictions. It's capital fleeing hope in tech and moving to hard necessity in resources.
Another mover was Nucor, N-U-E, steel.
Yeah.
Not exactly sexy, but showing some real resilience.
Classic accumulation. It's setting up for what we call a gap and go. It's holding near the highs. If it can clear Monday's high, it looks like a solid momentum trade. It tells you that, despite the tech weakness, there is still money flowing into industrial strength.
And then Eric, exploded 10.5% on a profit beat.
Massive move. Now, it's a bit overextended after a 10% jump, but looking at the tape, you can see the institutional sponsor footprints. Big blocks being bought.
Not just retail.
No, this wasn't just retail chasing news. Big money is buying that turnaround story. It's definitely one to watch for a pullback.
I want to zoom out to the macro picture because there was a historic milestone today that flew under the radar for a lot of people. Gold hit $5,000 an ounce.
5,000. That is a psychological barrier that has stood for decades as this someday target, and it shattered today.
What is that telling us? Gold is usually the anti-dollar or the anti-stability asset.
It's the ultimate vote of no confidence. And when you combine it with natural gas surging 20%, mostly due to winter storms, it paints a scary picture for the Fed. The inflation reacceleration narrative is creeping back.
Just when everyone thought it was dead.
Everyone thinks inflation is dead and buried. But when you see gold at 5,000 and energy costs spiking, that coffin lid starts to creak open.
And that leads us right back to Wednesday. If the Fed sees this.
They cannot pivot. They have to stay hawkish.
And if the Fed stays hawkish on Wednesday because of gold and gas,
then this entire equity rally evaporates. That is the risk nobody is pricing in. Everyone expects a dovish pivot, or at least a pause. If Powell comes out swinging because he's staring at $5,000 gold, look up below.
Okay, let's look ahead to tomorrow, Tuesday, January 27th. One day closer to the main events. What's the setup?
Well, based on today's price action, that high volume churn, the probability models are favoring mean reversion. We have about a 65% chance of CHOP just grinding back and forth, and only a 35% chance of continuation upwards.
So don't expect a rocket ship tomorrow.
Highly unlikely, especially with the consumer confidence print coming out. That's the catalyst. If that number misses, if the consumer is feeling worse than we thought, this neutral sentiment shifts to defensive very, very quickly.
So what's the strategy? How do we trade this waiting room?
First off, risk management. Do not chase the index at the 7,000 wall. The risk reward is terrible there because of that dealer dampening we talked about.
Right.
If you want to see if the market actually has legs, don't look at the S&P 500. Watch the equal weighted S&P, ticker RSP.
The equal weight, why?
Because of what we said about breadth. The RSP treats Apple the same as some random industrial company. If the RSP doesn't catch up to the cap-weighted index, it proves the floor is thin.
You need the average stock to participate.
You need the troops, not just the Mag 7. If RSP is red and SPX is green, stay away. That is a siren song you do not want to follow.
Do you have a specific high conviction play for this environment?
I like an asymmetric risk trade here. I'm looking at VIX call spreads, specifically the 18 by 22 strikes.
Walk me through that. You're betting on volatility going up.
Yes. You're buying the 18-strike call on the VIX and selling the 22-strike call against it to finance the trade. It's cheap right now because, despite that smirk, the VIX is still relatively low historically, but you get high convexity.
A big bang for your buck.
Exactly. A small move in the VIX gives you a big percentage return on the option. So if we get political gridlock from the shutdown, or if the Fed comes out hawkish,
the VIX spikes.
And you own that spike for pennies on the dollar. It's a low-cost hedge against a chaotic week. It's about surviving if the wheels fall off.
And for a stock play, a day two play.
Keep an eye on Ericsson. Don't buy the open. Watch for a pullback to the 9-period EMA on a 15-minute chart. If it touches that line and holds, that might be your secondary entry to ride that institutional momentum.
But the main message seems to be stay nimble.
Absolutely. Do not marry a position here. This is a trader's market, not an investor's market. With the gamma wall at 7,000 and the macro wall on Wednesday, you need to be ready to flip your bias in a heartbeat.
And keep one eye on that 10-year yield.
Always. If the 10-year spikes while breadth stays weak, that neutral sentiment we're seeing turns risk off faster than you can blink.
Before we go, here is something to chew on. We talk about gold hitting $5,000. Historically, every time gold breaks a major psychological barrier like that, it signals a fundamental shift in the monetary order. If gold is sniffing out something the bond market hasn't priced in yet, what does that say about the value of the dollars in your brokerage account come Wednesday?
That's the question that should keep you awake tonight.
The data is on the screen, the plan is set. Bells up, trade the plan.
Stay safe out there.
See you tomorrow, post-close.